To truly understand how to build an unbreakable personal financial flywheel, we have to step inside the boardroom of one of the most ruthless, highly efficient business transformations in modern history, in the early 2000s. Apple was not the tech titan we know today. They were struggling to maintain market share, surrounded by giant competitors and fighting for every single dollar of revenue, when Steve Jobs returned to Apple. He did something that confused almost every outside analyst on Wall Street. Instead of launching dozens of new products to make quick cash, he cut 70% of Apple's existing product line. He intentionally killed immediate revenue streams because he realized a fundamental principle of capital efficiency: complexity eats profit, and short-term income is the enemy of long-term dominance. Jobs reallocated every single dollar, every engineer, and every ounce of creative energy into building just 4 core products. He sacrificed short-term vanity metrics to build an integrated engine so powerful that when the iPhone launched, it created an economic wave that generated over $1 trillion in value. Now, ask yourself this critical question: are you running your personal finances like Apple before the turnaround? Or after? 90% of 20-somethings operate in a state of financial complexity. They scatter their early income across dozens of small, meaningless lifestyle expenses, impulse purchases, and low-value subscriptions. They have 10 different leaks draining their operating cash flow every single week, without a single unified asset engine working for their future. They are chasing tiny, short-term dopamine hits, while completely ignoring the core infrastructure of their lives. When you apply Apple's capital concentration secret to your 20s, your mindset shifts entirely. You stop trying to do everything, buy everything, and look like everyone else. Instead, you simplify your personal balance sheet with extreme discipline. You cut the low-value financial noise and concentrate your scarce early resources into building 1 or 2 compounding assets that will fuel your freedom forever. Let us look at a real-world case study, a micro-story of 2 friends, Marcus and Daniel, both 24 years old. Marcus decided to build what he called his personal asset engine. He lived in a modest apartment, kept his fixed overhead ridiculously low, and redirected 40% of his monthly income directly into low-cost global market index funds and high-value skill development. His friends mocked him, calling him overly cautious. While they drove brand-new leased cars and went on expensive weekend trips for 3 straight years, Marcus's life looked boring, almost invisible from the outside. He didn't have the luxury lifestyle to show off on social media, and his bank account seemed to grow at a painfully slow crawl. This brings us to the most dangerous phase of the investment flywheel, a period economists call the valley of latent potential. When you start investing in your 20s, nothing dramatic happens in year 1, year 2, or even year 3. The graph looks flat, almost useless. You put in hard work, make sacrifices, and the financial returns feel tiny compared to the effort you put in. This exact plateau is where 90% of young adults break down, give up, and sell out their future. They tell themselves, "This compounding stuff doesn't work, I might as well enjoy my money today." They pull their capital out of the engine, spend it on temporary comfort, and reset their compounding clock back to 0. But look at what happened to Marcus in year 7, because he kept feeding his flywheel during the quiet years. The mathematical inflection point finally kicked in. The interest generated by his early investments started earning its own interest, creating an avalanche of passive momentum. By age 31, the annual returns on Marcus's asset engine were generating more money than his entire yearly salary at his day job, without working an extra hour. His money was producing a full-time income in the background. Meanwhile, his friend Daniel, who spent his 20s upgrading his lifestyle to match every small pay raise, found himself completely trapped. Daniel was making more money at 31 than ever before, but his monthly expenses had grown even faster. He was stuck on what psychologists call the hedonic treadmill, forced to work 60 hours a week just to maintain an expensive life he didn't even have time to enjoy. One friend built an engine that bought him absolute freedom. The other built a cage made of expensive toys, and the terrifying truth is, Daniel didn't make a single catastrophic mistake. He simply fell victim to a subtle corporate strategy that targets every single young adult in the modern economy. Let us lift the curtain on the hidden business model designed to keep you broke: the subscription economy. Major enterprises realized decades ago that selling you a product once is inefficient. They want predictable, recurring revenue locked into your monthly budget for life, from software and entertainment to fitness centers and premium delivery services. Modern companies design friction-free systems that quietly auto-deduct small amounts of cash from your bank account every 30 days to your brain. A $15 monthly subscription feels completely harmless, almost invisible. But when you stack 6 or 7 of these small recurring payments together, you are effectively pledging a massive percentage of your future cash flow to corporate balance sheets before you even wake up in the morning. You are letting giant corporations build their compound flywheels, using your monthly income as their fuel. To break free from this hidden trap, you must adopt the ultimate corporate growth strategy used by elite wealth builders: the zero-based capital strategy. Every single month, top-performing corporations evaluate their budget from scratch. They don't assume last month's expenses were necessary. They force every single dollar to justify its existence before it is spent. When you apply this exact tactic to your personal life, you assign every single dollar a specific mission the second your income arrives. Dollar number 1 goes to security. Dollars 2 through 10 go directly into your growth engine, and only what is left at the end is allowed to be spent on lifestyle expenses. You flip the traditional formula completely on its head. Instead of saving what is left after spending, you spend what is left after investing. This simple, elegant operational shift eliminates the need for daily willpower because your system executes the strategy for you automatically. Consider another powerful business breakdown: Netflix's pivot in 2011. At the peak of their DVD by mail success, Netflix made a terrifying internal decision. They intentionally cannibalized their most profitable business segment to fund the development of streaming technology. Wall Street panicked. Stock prices crashed by over 60% in the short term, and critics declared the company doomed. But Netflix understood a secret that most 20-year-olds overlook: to step into a massive future, you must be willing to sacrifice short-term comfort and public approval today. If you spend your 20s trying to look successful to people you don't even like, you are sacrificing your future freedom for cheap, temporary validation. You are optimizing for the DVD business, while letting the streaming revolution of your net worth pass you by. The top 10% of wealth builders don't care about looking rich in their 20s. They care about becoming powerful in their 30s. They embrace the quiet years. They embrace the flat line of the compounding graph, because they know what lies on the other side of that inflection point. They know that every dollar invested at 22 is worth $10 at 42 and $30 at 62. They treat their early capital like seeds in a fertile field, refusing to eat the seed today when it can grow into an entire orchard tomorrow. So, as you look at your own bank balance, your daily habits, and the trajectory of your current lifestyle, ask yourself the ultimate forensic question: